the global economy operates as a highly interconnected system. Prices, borrowing costs, and economic activity are closely linked within this system. Understanding these elements is crucial for effective personal finance management. Changes in one area of the global economy can ripple through others. This interconnectedness creates both opportunities and risks for individuals. Therefore, economic literacy is essential for navigating the financial landscape. Inflation refers to the overall increase in the price levels of goods and services within an economy. This increase is measured over a specific period of time, such as a month, quarter, or year. Inflation erodes the purchasing power of money. As inflation rises, each unit of currency buys fewer goods and services than it previously did. Inflation arises from multiple factors affecting the balance of supply and demand. Demand pull inflation occurs when demand surpasses available supply, driving prices up. Cost push inflation results from increased production costs, which are then passed on to consumers. Expansion of the money supply by central banks can also lead to inflationary pressures. Economists use specific indicators to measure inflation. The Consumer Price Index, CPI, is a key tool for this measurement. CPI tracks price changes in a basket of common household goods and services. This basket represents typical consumer spending. CPI provides a quantifiable measure of inflation over specified periods. The index allows for tracking inflation trends and rates. Interest rates define the cost associated with borrowing money. Interest rates also represent the reward or return for saving money. Elevated interest rates increase the expense of borrowing funds. Higher rates incentivize individuals and entities to save more. Conversely, lower interest rates reduce the cost of borrowing. Reduced rates encourage spending and investment within the economy. Central banks manage inflation and promote economic stability. Interest rates are a key tool used by central banks. Raising interest rates combats inflation. Lowering interest rates stimulates economic growth during slowdowns. The U.S. Federal Reserve and the European Central Bank are examples of central banks. Inflation and interest rates are key macroeconomic factors influencing personal finances. High inflation reduces purchasing power, meaning each unit of currency buys fewer goods and services. Elevated interest rates increase the cost of borrowing, affecting mortgages, loans, and credit card debt. Conversely, higher interest rates can increase the returns on savings accounts and fixed income investments. Effective personal financial management requires balancing the impacts of inflation and interest rates. Inflation erodes the purchasing power of savings and investments. To counter inflation, focus on assets that outpace the inflation rate. Consider long-term investments for potentially higher returns. Real estate can serve as a hedge against inflation. Diversified index funds offer broad market exposure and growth potential. Avoid unnecessary debt and maintain an emergency fund for financial stability. Inflation, interest rates, and the economy are interconnected. These factors move in cycles, constantly influencing each other. Understanding these dynamics is crucial for financial decisions. Informed decisions can be made regardless of the economic climate. Continuous learning is crucial for effective financial management. Staying informed enables individuals to take control of their financial journey. Exploring financial topics in depth builds a solid foundation of knowledge. This knowledge is essential for long-term wealth accumulation. Ultimately, financial literacy promotes financial independence and security.